Okay, now I move to the next segment of the chapter. We have done equity valuation, we have done bond valuation. Combining together is called hybrid valuation. Combining them together is called hybrid valuation. The hybrid valuation part very frequently comes in exam. Once in 2-3 attempts they keep asking one question from here. Standard set of question. There are some 11-12 terms which you need to understand. What I will do is I'll first give notes on each of the term, show you an example in the material, and then we start solving the question later on. Our questions will not have much to do because it's broadly the same concept. I'll keep repeating the same concept in the valuation. Now go to the theory part and write convertible instruments. Convertible instruments. Convertible instruments. Convertible instrument is a hybrid instrument with characteristics of both debt and equity. This instrument will be converted into specified number of equity shares. Example, a company issued 2% convertible bond, which can be converted into 10 equity shares. Now let's first understand why this convertible bond came into picture. See, I am confident about the company's prospect. One company is doing really well. I am very confident that this company will do well in future, but still I don't want to take full risk. If you want to take full risk, buy equity shares of the company. Equity shares price go up, you get benefited. Equity shares price go down, you get impacted. Another approach is buy convertible bonds of that company. Many companies have issued something called as FCCB, foreign currency convertible bonds. So why do I issue foreign currency convertible bonds or normal convertible bonds? Why not separate bonds? If you issue bonds, it will be at 8%, 10% interest. Convertible bond normally is issued at a slightly lesser interest. So the redemption value of the bond is 1000 rupees. Most of the time I will have an option. If on the last day share price is less than 100 rupees, I will not convert into share because 1000 rupees is my redemption value. If I convert 10 into 90, I'll get only 900 rupees. I don't want to convert. 10 into 90 will give me only 900 rupees. I don't want to convert. But the share price can even be 800 rupees. If it's 800, I'll get 10 into 800. I will not pay any money. I have a choice. If it's optionally convertible. If it's compulsorily convertible, then it's not a technical. Compulsorily convertible, accounting wise or logic wise, it's like an equity share. It's like a equity share. Compulsorily convertible is more like an equity share. Optionally convertible means I will decide what I want to do. Company is doing really well, I'll convert into equity share. Company did bad performance, I will redeem it as debt. So debt gives me certainty of my inflow. Equity gives me participation in appreciation. If you invest only in equity, participate in appreciation as well as depreciation. participate in appreciation of shares as well as depreciation of shares. Share price can go down, share price can go up. I don't want to be impacted by the fall in price. So what option I did? I went and bought a convertible bond. I went and bought a convertible bond. If company does really well, there was one company called Suzlon which issued convertible bonds. The share price was 800 rupees when they issued. When the time came for redemption, people did not agree for conversion. Reason is that time the share price had crashed to 20 rupees. From 800, it has crashed down to 20 rupees. People said we don't want to do conversion. So they had to redeem it. The company defaulted because they did not have money to redeem. They did not have money to redeem the bonds, but people did not opt for conversion. Why will I opt for conversion? Because the share price from 800 had crashed down to 200. From 800, it had crashed down to 200. Lot of bad performance over a longer period. So those guys said, please redeem our bonds. We don't want to opt for conversion, because in conversion what will happen? I'll get 20 rupees into 10 or something. If I redeem, I may get 8,000 rupees or 9,000. That's a different story. There both became a problem because they did not have money. They did not have money. Both became problem for them. Then legal case, all that kept on happening. That's a different story. But here what I'm trying to do is I will invest in a company. If company does really well, I'll convert into equity. If company does bad, I'll redeem it as debt. That flexibility comes to me. But flexibility comes at a price. What's the price? You are getting only 2% interest. You're getting only 2% interest. Otherwise, what interest you would have got? 8% or 9%. That's one part. If you do intrinsic value calculation, you get the value of 600 rupees, but you will be asked to pay 800 or 900. You will be asked to pay 800 or 900, where I'm telling you that you have that option. No, so you pay me extra. You pay me extra, and people do pay extra. People do extra. What is intrinsic value? Year, cash flow, PVF, DCF. When you do that calculation, you get answer of 600 rupees. But people are going to pay 900, 1000, 1100, 1200, 1300 extra. You are paying extra. You are paying. Why do you pay extra? That's your wish. You are ready to pay extra. You're ready to pay extra. Any doubts on this? Clear? Now, add certain extra information here. Current market price of share is rupees 80. Face value of bond 1000. Face value of bond 1000. So that I can keep calculating all of those items which I want to do. Face value of bond 1000. Life 5 years. Life 5 years. Market rate of interest 5%. Ideally, you should pay 5%, but you're paying only 2%. Market rate of interest is 5%. Ideally, you should do that, but you're paying only 2%. Current market price of bond 1100. Current market price of bond 1100. You can leave a line or two. I may add extra information because depending on different terms, I may need some more information, like some as I do. If I need something extra, I'll tell you to add it in the example. Now, what is the rate of interest bond is paying? What is people expecting? Ideally, this should be issued at discount. Ideally, you should issue this at discount. What have we done? We have issued this at premium. We have issued this at premium. Why? Because you are giving them a benefit, saying that you can convert this into share in future, and the share price may go up. Share price may go up, may go down. We don't know what will happen. Now write certain terms. Leave 2 lines gap. Conversion value. Conversion value. Conversion value. Lot of terms I'll be introducing. Conversion value. Value which an investor gets. Value which an investor gets if conversion happens today. If conversion happens today. Value which an investor gets if conversion happens today. One bond can be converted into what? 10 shares. I'm saying go ahead and convert today. Go ahead and convert today. Is the conversion going to happen today? No. Conversion value assumes that if you convert today, what will happen? Now write conversion value is equal to 10 shares. What is the price of the share today? 80 rupees 800. 10 shares into 80 rupees 800. I don't know, before or after, write the formula. I should have given the formula. I don't remember the formula and all. I have given the logic. Logic is very simple. If you convert today, what happens? So current market price of share into conversion ratio. Current market price of share into conversion ratio. If you do conversion today, conversion premium, there are multiple terms which will be there. Conversion premium, extra amount paid in excess of conversion value. Extra amount paid in excess of conversion value. Extra amount paid in excess of conversion value. What is the value you have to pay to buy the bond today? 1100. Instead of buying the bond, I could have bought shares directly. I could have bought share. See, my ultimate objective was to buy share only. My ultimate objective was to buy share only. But I said, no, let me not buy the share. Let me go through the bond route. When I did it through the bond route, I have to pay how much? 1100. If I gone through the share route, I have paid only 800 rupees for 10 share. So extra paid is called conversion premium. The extra payment which you have done is called conversion premium. Conversion premium is equal to current market price of bond minus conversion value. Minus conversion value. What's the current market price of bond? Conversion value. Now this is answered in different ways, okay? Rupees 300 per bond or 300 per bond or one bond is how many share? So divide by 10. 30 per share. At a per share level, you are paying extra 30 rupees. At a per share level, you are paying extra 30 rupees. Or this extra 300 divide by 800. Extra 300 divide by 800. Into 100. Into 100. How much? 37 point. Listen for a minute. 37.5% of conversion value. That is, you are paying extra 300 on a base of 800. Extra 300 on a base of 800. So 37, I'll give you time to write. Listen, 300 on a base of 800. Tell me 300 divided by 1100 into 100. 300 by 1100. 27 point. Percentage of current market price of bond. This conversion premium can be expressed in different ways. You can say you paid 300 per bond extra. You can say you paid 30 per share extra. Or you can say you paid 37.5% extra of the conversion value. Or you can say you paid 27.27 percentage extra of the current market price. Like you have profit margin, which can be profit by sales, profit by cost. You can divide by sales, you can divide by cost. Same logic here. You can say 300 is extra on 800, 300 is extra on 1100, 300 is extra per bond or 30 per share. Sometimes ICA asks conversion premium per bond. Sometimes they ask per share. Sometimes they ask ratio. In ratio, sometimes they give 37.5 in the answer. Sometimes they give 27.27 in the answer. If they ask me conversion premium, I'll write all the four in exam. 300 per bond, 30 per share, 37.5%. Don't just write 37.5%. 37.5% of sales or of cost. Your profit margin can be on sales, profit margin can be on cost. So 37.5% of conversion value or 37.5% of current market price. You'll have to write that. So of conversion value and 27.27 percentage of current market price of bond. Any doubts on this? Write this. 300 by 800, 300 by 1100. Three hundred by 800, 300 by 1100. Which one do I write in exam? If nothing is clear in the question, write all the four. Write all the four. The first two is in rupees, the last two is in percentage. The first two is in rupees, the last two is in percentage. Clear? Can you proceed? Before I explain the next set of terms, in this example, tell me what is conversion value. Very simple example only. What is conversion value? No formula and all. Please don't get into formula. What is conversion? What is the logic of conversion value? If conversion happens today, one bond will be converted into how many shares? 5 share. What is the current price of a share? 5 into 15 is the answer. 5 into 15 is the answer, which is 75. Conversion premium refers to the extra amount you paid. You can do per bond, you can do per share, you can do percentage calculation, which can be a percentage of conversion value. It can also be a percentage of current market price. Please see this and tell me the answer. Same example only. Same example, tell me the answer. How much extra per bond? First tell me. What's the current market price of bond? What is the conversion value you told me? So extra 25 rupees per bond. Extra 25 rupees per bond. One bond is how many share? So divided by 5 is extra 5 per share. Extra 5 per share. Any doubts on this? Any doubts on this? Can we proceed? Next, right. Next term. Straight value, intrinsic value, straight value, intrinsic value, different names are there. Floor value, minimum price. Straight, intrinsic, floor, minimum price. This is nothing but present value of future cash flow discounted at investors' required rate of return. Ignore the concept of conversion in the calculation. So see this as a normal bond. See this as a normal bond. Don't see it as a convertible bond. Year, cash flow, PVF, DCF, you will get an answer which will be 100% lesser than 1100 because bond is paying only 2%. Market is expecting how much? 5%. So when you do discounting, you're going to get a significantly lesser answer. But still I'm paying more. I'm paying more because I believe if it gets converted into share at a higher price, I get benefited. So now write present value of future interest, and principal discounted at investors required rate of return. Discounted at investors required rate of return. Present value of future interest and principal discounted at investors required rate of return. We value this ignoring conversion option. Ignoring conversion option. How do you bring conversion to picture? You will understand as we proceed. Year cash flow PVF DCF. Year cash flow PVF DCF. Cash flow PVF at what rate? Whatever example you had, I keep going back to the example only. Year cash flow PVF at 5% DCF. PVF at 5% DCF. This is what we have been doing in bond valuation. Their conversion part was not there. Year cash. In fact, one problem we had convertible instrument. I said I'll explain later. I gave the answer and then proceeded at it. How many years is the life? 5 years. So 1 to 5 at the end of year 5. 1 to 5 and at the end of year 5. How much interest the bond will pay? So 20 rupees, 1000. Give me 5-year annuity factor and then close the valuation. Ideally, I should pay only this much, 870 rupees. Ideally, I should pay only 870 rupees for the bond. But I say I go ahead and pay extra. I pay extra. We have done one calculation called conversion value, which is if you do conversion today, what happens? Bond real worth as of now is 870.58. Any doubts on this? This is the real worth of the bond. Next, premium over straight value. Premium over straight value or downside risk. Premium over straight value or downside risk. Now, the classic example of downside risk is the Suzlon example which I was talking about. I pay how much today for the bond? What is the value I'm paying today for the bond? 1100. Why did I pay 1100 and not 870? Reason is very simple. In future, my share price will go up and I'll get a better valuation. I'll get a better valuation. So I was promised this. Assuming suddenly the company price starts crashing down. Company price starts crashing down. Share price starts crashing down. If share price goes down and conversion is not viable, conversion is not viable, the bond price from 1100 will crash down to 870 rupees. Bond price from 1100 will crash down to what? 870. Why 870? Because that's the real value. The real value of the bond is 870. What was 800? 800 is if you convert today. If you convert today, we are not going to do conversion today. That's a different calculation. Okay. Don't compare both the numbers. 870 is the real worth of the bond. But I paid how much? 1100 because I was promised that after 5 years, one share will be worth 300 rupees, 400, 500, 600, 700, very high value. It is going to be very high value. So I was very happy about all this. I was very happy and thinking that I'll get 5 shares or 10 shares by my whatever the conversion will happen at 1000 will become 5 shares. Whereas if I have to buy it in the market, I may have to pay for 5 shares 10,000 rupees. So that was my thought process. Unfortunately, share price which is today 80 went down to 70, went down to 60, 50, 40, 30, 20. Then you're saying this conversion and all is not going to happen. I don't know why did I buy this bond. So market, everyone feels this. If everyone starts feeling this, 1100 will go down to 870. 1100 will go down to, it will not go down to 800. It will not go down to 800 because conversion is anyway not happening. Conversion is not anyway happening. Why will it go down to only 870? Because the real worth of the bond is 870 and this is called my downside risk. This is called my downside risk. What is downside risk? Is the possible fall in the value of the bond if conversion is not viable. If conversion, can this 870 change? Yes, it can change if PVF at 5% becomes PVF at 7. PVF at 7, PVF at 6, PVF at 8, PVF at 10. Because today you are okay with 5% return on the bond. Tomorrow market changes. You want to change 5 years, 6 or 7. Again, the intrinsic value will change. Basic thing is what is downside risk is the value of the bond will fall down to its intrinsic value, will fall down to its intrinsic value because conversion is not viable. Conversion is not viable. Why conversion is not viable? Because earlier you were promising me saying that this 1000 which you get, see, year 5 I wrote 1000, no, logically you should not write 1000. The concept is 1000 or the likely price of 5 shares whichever is higher. 1000 or likely price of 5 shares whichever is higher. I'll do this valuation concept later. So after 5 years, instead of getting 1000, I may get 2000, 3000, 4000, 5000, 6000, 7, 8, 9. I can get anything. I can get anything if share price starts going up. But if it goes down, I'll at least get 1000. I'll at least get 1000. So my promise was that this 1000 will not be year 5 value. You will get 10,000 in year 5. Then I pay a very high price. Then I pay a very high price. That's why I was paying that price. I was paying a very high price because you promised me something saying that share price will start going up. You be prepared that the company is really good. It will get converted. It will get converted at a very high rate for you. You will be the beneficiary. So all that was promised. 80 became 70, 70 became 60, 60 became 50, 40, 30, 20. I lost all hope of conversion. I lost all hope of conversion. Now, right. Downside risk is the potential fall is the potential fall in value of bond, potential fall in value of bond if conversion is not viable. If conversion is not viable, if conversion is not viable, conversion is not viable. In this case, the value of bond will decline to its intrinsic value. Value of bond will decline to its intrinsic value. From today's price, it will go down to its intrinsic value. Premium over straight value or downside risk, whatever name you want to give, in rupees. In rupees is equal to current market price minus intrinsic value. Current market price of bond. See, again I'm repeating, I don't remember any of the formula. Be clear on the logic, because there are 10-12 formula which are going to come. If you are clear on the logic, you can write the formula accordingly. Current market price of bond minus intrinsic value. What's the current market price of bond? Intrinsic value. How much is the fall which is going to happen? 229 point, or I can convert this into percentage. Okay, this is not per share, we don't do per share here, okay, because this is only related to bond. Or 229.42 divided by 870 divided by 1100, divide by 870 divide by 1100, that is on your current market price you can divide, or on your intrinsic value you can divide. So next is 229.4, tell me the percentage. 229.42 divided by 1100 into 100, 20 point, in bracket 229.42 divided by 1100, 20.86 of current market price. That is, the current market price can fall by 21%. Be mentally prepared. Your current market price can fall by how much? 21% if the conversion is not happening. If the conversion is not happening, be mentally prepared to have a loss of 21%. Be prepared to have a loss of 21%. Or divide by 870.58 into 100, 26 point. Number mattum. Anyone has left a vehicle opposite to the gate? Number mattum. 26.35%. 229.42 divided by what? 870.58. This is percentage of what? Which is technically called straight value. See, when I ask you what is profit margin, you can say 25% on sales, 20% on cost. Like that, you have to give two answers. One on straight value, one on current market price. Why I am giving two answers? Sometimes ICA does it on straight value, sometimes they do it on current market price. In exam, let's write both and then leave it. Any doubts on this? Why not per share? Because this is related only to the bond. This has nothing to related with the share. Logic is very simple. If the bond starts behaving in a bad manner, that is, the share price is not doing good, the bond will crash down to its intrinsic value. Example, Suzlon. Suzlon, when you would have issued, you would have issued at a high price and all, giving some promise saying that share price will go up and all. Price did not go up. Price did not go up. If price does not go up, this is the problem for the company. Any doubts on this? Can you proceed? Straight value or intrinsic value. Face value of the bond is 100. Rate of interest is 8%. Return on similar bond is what? So I am paying only 8%. Others are paying how much? 9.5. My bond should be issued at discount. My bond should be issued at discount. Year cash flow PV of DCF, you get 95.26. You get 95.26. Using this, I can calculate downside risk in rupees, downside risk in percentage, which can be as a percentage of straight value or as a percentage of current market price. This and this is same, okay? The second formula and the fourth formula is same. Premium over straight value. That is how much is the extra over straight value. How much is the extra over straight value? Again, you can express it in rupees or you can express it in percentage. Okay, next is conversion parity price. Okay, write this first. Conversion parity price. I can only keep telling you that each of them, if you understand what is the logic, you need not remember the formula. Otherwise, unnecessarily remembering formula and all will come. I know where I will tell you to, till now only one place I want you to remember the formula, which is H model. Otherwise, other than that, I don't expect you to remember formula anywhere else. If you are clear on the logic, things will happen. What is conversion parity prices? If I do conversion today, what is the conversion value? 800. And what is the current market price of the bond? I don't want any loss if I convert today. That is, if I convert today, give me 1100. That is called conversion parity price. If I convert today, you have to give me 1100. You have to give me 1100. Conversion, if it happens today, should give me 1100 rather than giving me 800. If it gives me 800, why will I do conversion? I will not do conversion. If it gives me 1100, I am indifferent or at parity. I am indifferent or at parity. And if you give me more than 1100, I'm very happy. I'm very happy. So conversion parity price refers to the minimum price at which I will exercise conversion. Minimum price at which I will exercise conversion. So 1100 is the current market price. Conversion ratio, sorry, yeah, 1100. Conversion ratio is 10 equity share. Tell me, what is the conversion parity price? At what price will you agree for conversion? 110. What is 110? 1100 divided by 10. 1100 divided by 10. No need to remember the formula. Anyone's vehicle? 7525. 7525. 1100 divided by the conversion ratio. That is, if I do conversion today, price is 110. I'm happy to do conversion. Price is 110. I'm happy to do conversion. I'm at parity at that level. Price is 80. I don't want to do conversion. Why will I do conversion? Because 80 into 10 will give me what? 800. What's the current market price of the bond? 1100. I will not do conversion. In short, conversion parity price refers to the price at which conversion premium will be zero. Conversion premium has to be zero. I don't want any conversion premium. What is the conversion premium per share? You have in your notebook. What is the conversion? Look at here. 30. 80 plus 30 is the conversion parity price. 80 plus 30 is the conversion parity price. There are different ways of calculating it. 80 plus 30 is the, I don't want to pay any premium. What is conversion parity price? The price at which if I do conversion today, I suffer no profit, no loss. No profit, no loss. Now write. Conversion parity price refers to the minimum price. Refers to the minimum price at which conversion can be done. Minimum price at which conversion can be done without any loss to the investor. Without any loss to the investor. Conversion parity price is equal to current market price of bond divided by conversion ratio. So I give a formula. I'm not very interested in telling you a formula. Understand the logic alone. What's the current market price of a bond here? Conversion ratio. Sorry, 1100. 1100 by 10 rupees. If it's 110, it is at parity. 110 is at parity. Anything more than 110, I'm very happy to do conversion. Anything more than 110, I'm very happy to do conversion. Is the conversion choice in the investor's hand? It is optionally convertible, but the instrument will tell when it has to be converted. The dates will be predefined. It could be at any point of time, or it could be only on the last day, or it could be every year. That the bond, whenever you are issuing the bond, the terms of the bond will say. I am only telling, if you want to do conversion today, Give me the share price should be 110. The share price should be 110. Otherwise, I don't want to do conversion. Otherwise, I don't want to do conversion. This can also be called as, right, market conversion price or minimum price for conversion. Market conversion price or minimum price for conversion. My only request is understand each of the term properly so that you need not by heart any of the formula. Understand each of the term properly so that you have clarity on every term here. That's why I've started with an example. In the last batch and all, directly I did a problem. Here I'm giving one full example explaining each of the term, because totally 12-13 terms are there. Will not be able to complete everything in today's session, but let me do whatever maximum terms are possible. Any doubts on this? Can you give me the conversion parity price for this? Same example. The example remains same. 100 divided by 5. 100 divided by 5. You can just write one more name for this, break even price. This is also called break even price. In your different names, you can write break even price. Okay, next comes a term called favorable income differential. In the example, please go up and write dividend per share. I want this data also. Dividend per share rupees. Just give me a minute. Okay, rupees 0.5. Dividend per share rupees 0.5. Okay, now listen. There's something called as favorable income differential. What is favorable income differential is? I asked you, do you want to buy share or buy bond? You say I wanted only shares. I wanted only shares, but you're little worried about one element. What is the worry is that in case share price crashes down, you have a problem. So that is why you wanted to go through the bond route. So bond route gives you two benefits. One, fall in prices not impacting you. The second benefit is how much is the interest income per bond? Or what is the rupee term? 20 rupees. You got 20 rupees because you bought the bond. I purchased 10 shares. I purchased 10 shares. I went ahead and bought the shares directly. I went ahead and bought the shares directly. You went ahead and bought the bonds. You got income of 20 rupees. I get income of 5 rupees only. I get income of 5 rupees. What is 5 rupees? 10 into 0.5. 10 into 0.5. So you are having a favorable income differential of 15 rupees every year. You are having a favorable income differential of 15 rupees per bond, can be converted into per share also. Can be converted into per share also. This 15 rupee can change if the dividend changes. Dividend can change in the practical world, but the benefit of investing in the bond is you get interest income. I get dividend income. Interest income will obviously be higher. Interest income will obviously be higher than a dividend income, because dividend practically yield is 1% or less than 1%. Interest normally is 5-6%. Normally is 5-6. This is a very example where I've just given 2%, but normally you pay an interest of 5-6%. So by investing directly as a bond, that is as a convertible bond, you get two benefits. One is every year you get extra income. Every year you get extra income. And second is, in case price crashes down, you are saying you're not going to opt for conversion. But for all of this, you have to pay extra 300 rupees. For all of this, you have to pay extra 300. What is that extra 300? You are paying 1100. I will pay only 800. I'll pay only 800. I bought 10 shares. You bought one bond. I bought 10 shares by paying 800. You bought one share. So you bought one bond by paying how much? 1100. You get extra income. You are not impacted by the fall in price. I get lesser income, but I'm impacted by the fall in price. So that's a price I'm paying. I'm okay to pay 800. You are okay to pay 1100. You are okay to pay 1100. Now write favorable income differential. Favorable income differential. Favorable income differential. This refers to the extra income received from convertible instrument received from convertible instrument as compared to direct purchase of shares, as compared to direct purchase of shares, as compared to direct purchase of shares. Favorable income differential is equal to interest income per bond, interest income per bond, dividend income for 5, 10, 15, 20, whatever number of shares. It can be any number, okay? It can be 5 shares, 10 shares, 15 shares, 20 shares, depending on conversion ratio. So basically it's dividend income for shares. The number can be anything. The number can be anything. One question will say 5 shares, another question will say 10 shares, another question will say 15 shares. In our example, favorable income differential is equal to favorable income differential is equal to differential is equal to what is the interest income per bond? Rupees 20. Dividend income for how many shares? 0.5 into 10. Rupees 15 per bond or rupees 15 per bond. Please convert this into per share. 15 per bond or rupees how much? Per bond or 1.5 per share. Rupees 15 per bond or 1.50 per share. Any doubts on this? What is favorable income differential is because you bought a convertible instrument, there are benefits as well as disadvantages. Main disadvantage is extra premium you paid. Main disadvantage is that. But the benefit is I get extra income. See, your purpose was to buy share. But you said I don't want to go through the share route. I want to go through the convertible route. I want to go through the convertible route. You are getting every year 20. I am getting every year 5 rupees. So you are happy about it because you get extra 15 per bond or 1.50 per share. Please, in this example, can you tell me what is favorable income differential per share? This is a different example. Point 8. In the concept book later on, just correct, okay? It's not into 100. It's not into 100. There's an error there. Into 100 expresses percentage. So 10 rupees is the interest income on the bond. On the share, you will get 0.2 into 10, 2 rupees. 0.2 into 10, 8 rupees extra per bond. Divide by 10, per share is 0.8. Per share is 0.8. Next, right. Premium payback period. Premium payback period. Premium payback period. I don't expect you to remember any formula as long as logic is very clear to you. How much is the conversion premium we paid in this example? 300 per bond. Per share? 30. Listen, if conversion is not done by me, I keep waiting. This 300 I can recover in 20 years. What is 20 years? Is 300 divided by 15. Every year you pay me extra 15. Every year you pay me extra 15. Ignoring the time value of money. I'm ignoring the time value of money in the calculation. Every year you pay me extra 15 rupees. I paid a premium of how much? 300. If I want this premium to return to me, ignoring time value of money, it will take 20 years. 20 years is not viable here because the bond will get converted in 5 shares. But to get the premium back, you have to wait for 20 years. How is the calculation? Conversion premium per bond divided by favorable income differential per bond, or conversion premium per share divided by favorable income differential per share. You are getting every year extra 15 rupees. So in 20-year period, this is not a very good example. Whenever we do a problem, there the premium payback will be lesser than 5 years. The question would be framed in such a manner that it will be lesser than 5 years. I framed a question which is leading to a 20-year period, which means your premium will never come back because 5 years is the life. The life is 5 years. But what is premium payback period is the recovery of your conversion premium through the favorable income differential. The recovery of conversion premium through the favorable income. See, you paid 300 extra, you get every year extra 15. I did not pay extra 300. I'm not getting anything extra because I bought shares directly. You bought it as bond. You bought it as bond. So whatever extra you paid, I'm saying be happy, every year I'll pay you extra 15. In this example, if it is 15, but some other example, let's assume it is extra 100. Then in 3 years, that 300 will come back to you. In 3 years, 300 will come back to you. Now write premium payback period, but ignoring time value of money, okay? Because you are dividing by that 15 means every year you're valuing it as 15. So we are ignoring time value of money. Premium payback period refers to the number of years taken to recover, conversion premium, number of years taken to recover conversion premium through favorable income differential. I don't expect a formula to be known to you. Understand logic, you can do any type of question. Premium payback period is equal to conversion premium per bond divided by favorable income differential per bond. You can do per share also, okay? Per bond or per share, denominator. So per bond or share, denominator also per bond or share. In this example, tell me what is the conversion premium? 300. What is the favorable income differential? So it will take 20 years to recover the money. It will take 20 years to recover the money, which is technically not a good example because I should have framed the question differently, but it will take 20 years for me to recover the premium. It will take 20 years. Within that, the conversion itself will happen. Any doubts on this? When the conversion has not happened, correct? Without conversion, you are getting your income differential. Moment conversion happens, it is a share only after that. After that, there's no favorable income differential. What is, I'm not taking conversion into consideration. How much extra did I pay today? 300 rupees. How much extra I paid today is 300 rupees. I recover that over a period of next 20 years. Because 20 years, the conversion will happen in 5 years, no? 5 years is the life of the bond, no? Life itself is only 5 years, no? Where is after 5 years calculation? So 6th year, 7th year, how will you get favorable income differential? The bond itself gets over in 5 years. In this example, tell me the premium payback period. Per bond is 100 rupees extra. Favorable income differential per bond. Per bond is 4 into 10, 40. 4 into 10, 40. 100 divided by 40 or convert 100 as 10. 10 divided by 4. Consistency needs to be there. Consistency needs to be there in the calculation. Any doubts on this? Okay, valuation part I'll do it in the next session because I just need to explain one more concept there. It will take a little bit of extra time. I'm yet to even start with the problem, go through all these concepts. Again, I'll revise these concepts and then we start doing questions on your conversion instrument. I'll end with this.